Meet Andy. He's the resident manager of Paradise Hotel. He runs the operation of Paradise Hotel and he runs it very efficiently. He's basically very good with metrics like occupancy, RevPAR, etc. However, Andy has some trouble with hotel performance metrics. And in particular, he has a fear of numbers. This video is committed to removing Andy's fear of hotel. How to read your profit and loss statement. The three most critical numbers in your monthly profit and loss statement you will look at should be top line, bottom line, and cause in that order. Let us see some actual numbers in a summarized profit and loss statement extracted. In this simplified profit and loss statement, there are only rooms and food and beverage departments. You can see that the three most critical elements are revenues, profits, and the cause, both rooms and food and beverage. This is the big picture overview. Every month, you should get into the habit of looking into these three elements in any profit and loss statement. The key thing to remember is that you begin with revenues, top line, without which there are no profits, bottom line. Let us go back to our three critical elements again. So, the three most critical elements in a profit and loss statement of top line, bottom line, and cause are represented here by gross operating revenues, gross operating profit, and the cause, which is both in the rooms and food and beverage operation. For the hotel as a whole, we will see why rooms and food and beverage are considered here as a cause for the entire hotel. This has something to do with the contribution of rooms and food and beverage departments to hotel revenues and profits. In a profit and loss statement for a specific department, for example, food and beverage, however, they will still represent the same elements, revenues, profits, and cause. The only change will be the cause, which will be specific to that department. Notice something else. In our big picture overview, we have now moved one level down. We are now looking at a specific operational department's performance. It is again critical to repeat that an analysis of a profit and loss statement must always begin with a big picture overview at hotel level, as we did just a couple of slides back. After that, we can drill down and go into specific department's contribution to the hotel results. However, even in a specific department, the order is still the same: revenues, profits, and cause. Notice also that the cause has now become specific to the rooms department, occupancy, and average rate. Let us now summarize our learning. The first key concept in reading your profit and loss statement is that you step back and see the entire performance. In other words, you are taking a big picture overview. Next, you identify what is causing the performance in totality. In this approach, you saw how you looked at the gross operating revenues of the hotel, then gross operating profit, and then identified that rooms and food and beverage departments are causing the major revenue and profit performance of the hotel. This is actually true of almost all hotels, irrespective of how big or small the hotel is and how many restaurant outlets are there in the hotel. In the identification of causes, the important thing is to separate business volume from price. Pause the webinar and write down one major relationship you can think of between numbers in your monthly profit and loss statement. Relationships play a powerful role in understanding numbers in a profit and loss statement. We will now look at the most basic relationship of numbers. Every number in your profit and loss statement is related to one or more numbers therein. The most fundamental relationship between numbers is that of the number causing something and the number which becomes the effect. Once you understand how to distinguish which is cause and which is effect in numbers, you will take your understanding of the profit and loss statement to a whole new level. Notice how the cause circle is so much bigger than the effect circle. That is how important cause is compared to effect. There can be different kinds of relationships between numbers in a profit and loss statement. The first of these is related to period. One of the most powerful analytical elements relates to the performance of the current month. In other words, what happened in the current month is the cause, and what is shown in year to date is the effect. What does this mean? Let us take a look at an example. Assume that we have just completed February 2015 month. So the current month this year, 2015, here is the performance for the month of February and for the corresponding month last year. The year to date February 2015 is, however, different. It takes into account the performance of 2 months, January and February 2015, and correspondingly for the last year. This emphasizes a powerful principle of the period based relationship overview. Year to date February 2015 is simply the current month February 2015 performance added to the January performance, and similarly for the last year. So, what changed the year to date of February 2015 from January 2015 is the addition of the February 2015 performance. In other words, year to date is the effect and the current month performance the cause. The next key concept in reading your profit and loss statement is that you begin with the cause and move on later to effect. In other words, you are using the relationship overview. By focusing on what happened during the current month, you are ensuring that you understand what is causing the performance at the level it is. After having understood the cause and effect part, the next most critical relationship in your profit and loss statement is actually locating the cause. What you see as revenues, profits in your profit and loss statement is actually the effect. So then logically, where is the cause? It is in the hotel operation. This is yet another realization which will elevate your understanding of a profit and loss statement a great deal. So what do we mean when we say the cause is located in the hotel operation? In this profit and loss summary, we see that the gross operating revenue, remember we begin with the revenues first, has increased. It could have increased only due to two reasons: occupancy and average rate. So you have to go into the rooms division performance and market segments to find out which room types and segments had higher occupancy, and similarly for the average rate. Why your revenue increased and whether due to occupancy more or average rate or both is something that you can only find by going to the hotel operation, rooms division, and sales and marketing. After locating the cause wherever relevant, you have to take action in your hotel operation. This link to your operation slide is another which will pop up in every webinar. Check back with your hotel operation and your monthly profit and loss statement for the relationship overview. The next major area in understanding and reading a profit and loss statement is about variances. Variances broadly show you whether performance became better or worse. In other words, did your revenues increase or decrease? And similarly, did your profits increase or decrease? Between revenues and profits is, of course, expenses. A key concept in reading your profit and loss statement relating to variances is that you concentrate on current month performance increases or decreases in variances first. When you look at variances for profits, you have to see it in two ways. Did profit increase because revenue increased, or did profit increase because expenses decreased? Normally, it is a mix of both. Here you see that totally for the hotel, expenses have increased. However, within departments, you may find some expenses going down and others going up. In the previous Business Concepts webinar series, you also learned about fixed and variable expenses. Why should we separate profit variances between revenues and expenses? This is simply because of the relationship overview we started with, finding cause in the hotel operation. If you want to analyze how your profit went up or came down, you must first find out how much of it is due to revenues and how much due to expenses, and then do the same thing going into each department. Remember how we did it for rooms and food and beverage. One of the first things you need to understand about budgeting and forecasting is getting a good handle on your income statement, or the profit and loss statement as it is often called. So here is a profit and loss statement or an income statement, and I'm going to point out a couple of very important elements that you must understand before you even get into budgeting. So take a look at the annotation marked 1. This is the current month for which the budget is being compared with the actuals. You will notice in that current month, there are three columns: an orange column for actual, which is the current month, this year actual. The next is the budget. This is the budget that you are setting yourself, a target if you want to call it that. And then the third column, a very important one, is a variance column. The variance column actually shows you the difference between actual and budgeted. So in a way, you are telling yourself, did you do better than the budget, or did you fall behind the budget? So that's your current month. That's number one. Number two is something slightly more complex, and it's called year to date. Year to date is the actual number of months completed in the current year. So take a look at the columns which are on year to date. So in this particular case, again, you will find that the year to date has those three same columns as the current month had, which is actual, budget, and variance. But there is a difference. Year to date takes into account the number of months included in that year to date calculation. So while current month is only dealing with 1 month, the current month, year to date might be more than a month. For example, if you are doing this income statement for the period, say, ending 31st March, then you would have year to date including January, February, and March, while current month would only show the month of March. Take a look at the last column on number 2. It shows an actual number, which is the number for the previous year. This is a very important comparison. So while all the other 6 columns are comparing with the budget, this particular amount and this particular column is telling you how you are doing compared to the previous year. All right, let's proceed further. Number 3 on the ultimate guide on hotel budgeting and forecasting is the actuals that we talked about for a period based on the profit and loss statement. Now, actuals, as we saw earlier, have both a current month version as well as a year to date version, not to mention a previous year version. So number 3 is all about actuals. Number 4 is the budget amount to which you compare yourself on every element of the income statement. For example, you would compare your revenue, your payroll and related costs, your other direct costs, and so on. So number 4 is the budget. Number 5 is the variance between the actual and the budget. And this is an important column because whenever you set a budget, you would like to measure yourself against that. And the variance allows you to do that. You can calculate a variance both for the current month as well as a year to date. These two tell you whether your variance for the current month as well as the year to date are behind or ahead of budget. Now on to number 6. Number 6 is the total revenue budgeted for the hotel for the period. In the hospitality industry, there is a saying, if there is no top line, there is no bottom line. This shows you the total revenue right here. Number 7 on this particular ultimate guide on hotel budgeting and forecasting is about the total expenses budgeted for the hotel under various categories, expense categories, that is. So as you can see, number 7 has both direct revenue producing departments with their expenses and undistributed operating expenses. Undistributed operating expenses are simply overheads, expenses which you cannot directly relate to any particular department. And that is why you see administration and general, sales and marketing, property operation and maintenance, utilities. These are expenses for the entire hotel and not just for any one particular department. Number 8 and last on the list is the total profit budgeted for the month, the year to date, as well as the actuals compared to that budget. Profit is also known as net income. Overall, the elements 1 to 8 give you a very broad overview of where your hotel budgeting and forecasting is headed. In other words, what is it that you do in your hotel budgeting and forecasting? How important is the long-term financial health of your business? Did you see that coming? Yes, long-term health is very important, whether it's your own health or the financial health of your business. We are going to take a look at this Paradise Hotel balance sheet and understand its most important components. Well, you see, most hotel managers are familiar with the profit and loss statement, which they look at every month. But when it comes to the balance sheet, they really are not very
keen on looking at it. In a way, it looks like you are not very particular about the long-term health of your hotel business. I hope not. But let's see why that is so important. In this ultimate guide, I will introduce you to this very powerful financial statement and get to know why it is important to understand the financial health of your business all the time. This is the balance sheet of Paradise Hotel. This is the financial statement I was talking about, and we are going to take a look at this closely. At least we are going to look at its most important parts. The hotel balance sheet has predominantly three parts to it. The first part contains the assets. We'll come to assets very shortly. The second part is about liabilities, and we will visit liabilities as well. And the third and last part is about owner equity. Now, you may be wondering what these assets, liabilities, and owner equity represent. Well, they represent something very important to your business. Remember the long-term financial health that I talked about? Well, the assets are what the business owns. As you can see, that is marked by the alphabet A. The liabilities and the owner equity represent what the business owes and are denoted by the alphabets L and E. So as you can see, A equals L plus E means assets equal liabilities plus owner equity. This in financial terms, or actually accounting terms, is known as the fundamental accounting equation. Don't worry, we're not going to be accountants, but it's important to understand what assets, liabilities, and owner equity stand for. And so here is the balance sheet of Paradise Hotel. Let's look at the annotation number 1. And we are going to understand the relationship between the hotel balance sheet and another very important financial statement, which hotel managers are more familiar with, the profit and loss statement. And what is this relationship? Well, the balance sheet shows you the financial position at a point of time. Note in this Paradise Hotel balance sheet, the financial statement, the balance sheet, is as at 31st December 2019 and 2018. So it's on the last day of the years 2019 and 2018. How is it different from the income statement? Well, the income statement tends to show the performance for a period, and we will see how this works in the ultimate guide on the income statement, which is also known as the profit and loss statement. Number 2, the block which we saw earlier is about the assets of Paradise Hotel. Let's take a closer look at it. As you can see, the first subcategory in assets are current assets. You can see cash, short-term investments, accounts receivable, inventories, prepaid expenses. These are all current assets. Current assets are assets whose life is within one financial year, or what we could say is they get used up or converted into cash within one financial year. And then you can see the total of the current assets there. The next category of assets are investments. Investments are monies placed by Paradise Hotel on real estate or equity stocks in order to earn a return on investment. Next type of asset, and a very important one at that, is property and equipment. As you can see, the three categories here are land, buildings, furniture, and equipment. Buildings particularly represent the guest rooms of the hotel, which actually produce the room revenue. So property and equipment are long-term assets compared to current assets, which are short-term assets. A related concept is depreciation, which we will see in a later video on the ultimate guide to hotel profit and loss statement. A total for the net property and equipment, which is the property and equipment cost less accumulated depreciation, terms we will understand in a later video. Next comes other assets like operating equipment, and finally total assets, which is, if you remember, the earlier slide was all about what the business owns. So total assets represent what the business owns. Number 3 on this Paradise Hotel balance sheet are liabilities. And as you can see, just like current assets, you have current liabilities. Current liabilities are those claims or obligations that Paradise Hotel must pay within a financial year. And you can see the subcategories as accounts payable, accrued income taxes, accrued expenses, and something called the current portion of long-term debt. We will go into more detail in later videos when we describe current liabilities and a total for current liabilities. Next comes long-term debt. Long-term debt basically are loans taken by Paradise Hotel. If you remember, in an earlier slide, we talked about what the business owes. Well, long-term debt along with current liabilities are what the business owes. The subcategories, as you can see in long-term debt, are mortgage payable and deferred income taxes. This is followed by a total for long-term debt. And then comes the total liabilities. Total liabilities represent what the business owes, as we mentioned earlier. Let's get into the section 4 of Paradise Hotel's balance sheet. Section 4 is about owner equity. Owner equity is also something that the business owes. And as you can see, the subcategories represent common stock, paid in capital, and retained earnings, all of which we will see in a later video. This is followed by a total for the owner's equity. And then comes the total for both liabilities and owner's equity, which, to repeat, are what the business owes. Getting into number five. Number five is actually total current assets, assets which show short-term solvency and liquidity. So total current assets are on the one hand and total current liabilities on the other. Number six is about net property and equipment, which we saw earlier, which is the cost of property and equipment and deducting accumulated depreciation from it. Finally, number seven represents the total assets. If you remember, this is what the business owns. And on the other hand, this is balanced by the total liabilities and owner equity, which represent what the business owes. And if you remember, what the business owns and what the business owes are part of the fundamental accounting equation.